quite literally my day job to understand these loopholes, and I actively use and have seen these used every month by investing customers. Let's get into it. Section 1. Property trader exemptions. So this section of loopholes I'm about to go through are specifically for property traders or home buying companies that essentially buy a property to then sell it on for a profit. Like my business, British Homebuyers, for instance. But of course, this extends to any of you that basically trade properties as a business. You buy a property, refurbish it, you sell it on. Later, I'll go through 6 further loopholes that can be used by anyone buying property to hold on to long term. But for property traders, these are the 4 key ways to avoid stamp duty trading properties. So I'll rattle through these 4 key ways, then end with some really important caveats, essentially catches you've got to follow when doing this. Otherwise, you will lose the stamp duty exemption on these 4 key loopholes I'm about to go through. So please watch that bit at the end of this section so that you don't misunderstand these loopholes. Loophole 1. Chain repair. So a chain repair is where you come across a property that is currently sold where the owner of that property is in the process of buying another property. So they are essentially in a chain. Now, if their sale falls through, their buyer decides to pull out for whatever reason, you then have a situation where the chain is broken, and as a property trader, you can step in to repair that chain by buying that property that is fallen through. And in the process, you pay no stamp duty whatsoever for facilitating that. However, there is a catch to this that I'll go through after I've explained loopholes 2, 3, and 4. Loophole 2 is corporate relocation. So this operates in exactly the same way as with chain repair. You can save on stamp duty if you're buying a property from a seller that needs to specifically relocate for work. Again, I'll mention the important catch to this after loophole 4. Loophole 3 is probate exemption. So if you buy a property from personal representative of someone who has sadly passed away and they lived there as their main residence in the 2 years before they died, then again, no stamp duty land tax applies. And loophole 4, seller's onward purchase is a new build. So this is common with home builders that offer part exchange. You've probably come across that in the past. So they'll avoid paying stamp duty on buying the property from the person that's buying their new build. But what people don't realise is anyone can buy a property from a seller going on to buy a new build and get the same full exemptions from stamp duty. However, like I've said a few times now, loopholes 1, 2, 3, and 4 are only stamp duty exemptions available to property traders. So there are conditions a property trader must stick to after they purchase the property to continue remaining eligible for paying no stamp duty. They are: number 1, you must operate as a property trading business, which is easy enough to do. You just need to be clear it's a service that you're providing as a property company. You've got to have a property company where you buy and sell properties. Next, the seller must have occupied the home as their main or only residence for the past 2 years before selling. Next, the house and its land bought by the property trader, by you, must not be larger than 0.5 hectares. So if the size of the land exceeds the permitted limits, there is partial relief that can be given to reduce the overall stamp duty cost for who is the property trader. And there are 2 further quite key points to this as well. You can't buy the property to keep long term. You have to trade it on, otherwise you'll lose the stamp duty relief if you start renting it out, for instance. However, you can refurbish the property, spending up to the limit of £10,000 or 5% of the purchase price up to £20,000, whichever figure is greater. So really, if you're a developer flipping properties, looking to buy properties, do a light refurb, resell them, this strategy is absolute gold dust for you. As on a £150,000 purchase, for instance, you're going to save the 2% stamp duty, totaling £3,000, plus the higher rate stamp duty of 5%, totaling £10,500 in total, which you can then use to do a light refurb and sell it on at a profit. You can apply for these exemptions up to 4 years after the purchase. So if you think you've actually hit this criteria on previous purchases, it's not too late to apply for the exemption. And in case you're thinking it's quite unfair that property traders get this stamp duty exemption, the logic of the value it applies to society, to the market, is it lubes up the property market. So if a sale falls through, having someone step in to save the sale then protects the whole chain, or enabling someone to buy that new build property more easily helps developers sell stock to go on to build more property and so on. That's why traders can't hold on to these properties, because the stamp duty exemption is in place to help transactions move through the system, not to encourage properties out of home ownership into the buy-to-let market. Section 2, other stamp duty exemptions. So this second section are stamp duty exemptions that can be applied to anyone buying a property to live in or to hold on to longer term as a buy-to-let, for example. So Loophole 5, quick favour. Currently I have the goal of trying to get this channel to over 10,000 subscribers. So if you're finding this video at all useful, please like and subscribe or leave a comment, because it helps make the channel bigger. That then helps me spend more time and resources to try and make these videos even better for you in the future. Anyway, back to Loophole 5, buying a commercial or mixed use property. So these are standard residential stamp duty rates pre and post April. Plus, don't forget you have the higher rate of 5% on top if you're investing in the property or you're buying a second home. Now, these are the non-residential stamp duty rates that have no additional high rate of 5% stamp duty on top. Do you notice the difference? They are way, way lower. Now, unless a commercial property is listed, planning has relaxed a lot over COVID with commercial property, and is generally far more straightforward to convert a commercial property or a mixed-use property like a shop with a flat above into a full residential property. Now, I know not every property will be suited, but there are those that will. And the benefits are you're paying far lower stamp duty rates. The cost per square footage can be a lot less. And there's lower competition to purchase as it's outside of people's comfort zone. So it's allowing you more room to either add value as an investor to make more money or get more home for your money as a homeowner. With more and more companies working remotely, the commercial property market has been really suffering, which is what can make commercial property that is suited to converting into residential property. It's what can make it really, really good value for money. Loophole 6, buying 6 or more properties at once. So this stamp duty loophole is evidence of clear inequality in the tax system when it comes to stamp duty specifically, because you can pay non-residential stamp duty rates and not pay the 5% higher rate additional stamp duty if you buy 6 or more properties within one transaction, within one investment strategy. So clearly for most people, buying 6 properties at a time isn't feasible or affordable, but for many bigger landlords, bigger commercial landlords and companies, like Lloyds Bank, for instance, trying to become the UK's biggest landlord, they are literally buying hundreds of properties at once. So let's quickly work out how big a saving this equates to. If you buy a home for £250,000, you'll pay £2,500 of stamp duty. If you buy a buy-to-let property for £250,000, you will pay £15,000 of stamp duty. If you buy 6 £250,000 properties at once, you will pay £2,000 of stamp duty per property. How does that make any sense? You pay 20% less stamp duty than someone paying a home because you're buying at mass. So when Lloyds Bank added 84 homes to their portfolio of 5,000 buy-to-let properties, they paid less stamp duty than you or I would buying a home. Loophole 7, buying a company, not a property. So this does follow the same thread as buying 6 or more properties at once. It is sort of another demonstration of inequality in the tax system you can either take advantage of course rightly complain about. So instead of buying the property directly, you can purchase the company that owns the property. Now, why is this a game changer? Well, this is considered a transfer of shares, which means you only pay 0.5% stamp duty, which is clearly a massive saving. Now you might be thinking, how often are you ever going to come across a company for sale with properties you want rather than a individual property for sale. But with the implementation of Section 24 pushing more landlords to own properties within companies, more and more people own buy-to-lets through limited companies. And so we might find it becomes easier and easier to come across these sorts of opportunities in the future. Certainly for some time now, big corporate landlords have already been targeting big property portfolios where an investor might have spent decades building up a high performing portfolio with dozens, hundreds, even thousands of properties that a big corporate landlord will just sweep in and purchase as a company, and in the process save a fortune in stamp duty. Loophole 8, buying properties under £40,000. So you pay no stamp duty on properties valued at less than £40,000. This includes both the standard stamp duty and the 5% surcharge for additional properties or investing. Now you're probably thinking, how often are you going to come across any property on the market for less than £40,000? But if you're looking up north, for instance, there are some high growth areas where property prices are still at this level. So this is not a bad way to go, especially if you're new to investing, you've got smaller budgets. Why not focus on those smaller properties? Loophole 9, buying an uninhabitable property. So let's talk about uninhabitable properties, because many assume that if a property is deemed uninhabitable, they automatically qualify for non-residential stamp duty rates. But that's where a lot of people run into trouble. Why? Because they either don't have the proper evidence to prove the property is truly uninhabitable, or they misinterpret the criteria of what uninhabitable really means. So what qualifies a property as uninhabitable? Generally speaking, we're talking about things like major structural issues, or a lack of basic utilities like water or electricity, or severe damp problems, or roof damage making the property completely unsafe. If you can document these issues properly, you can save a significant amount on stamp duty. But if you don't have the proof, you could end up with a hefty stamp duty bill and no way to challenge it. So make sure you do your homework on this one if you're going to use this strategy. And finally, our bonus 10th loophole. Now here's a clever strategy not many people know about. When you're buying a property, you can actually reduce your stamp duty by separating the value of chattels from the property itself. Now you might be thinking, what are chattels? Chattels are the movable items in a property, things like ovens, blinds, curtains, light fixtures, white goods. These are not part of the property structure itself, so you don't pay stamp duty on them because they're not part of the property technically, they're add-ons. On the flip side, fixtures, built-in items like boilers, radiators, fitted kitchen units, sinks, baths, they're all considered part of the property, and stamp duty does apply to the value of those things. So when you're buying a house, make sure, if you want, to separate the value of the chattels in the contract from the purchase price. It might seem small, but this simple move could save you a decent chunk of cash on stamp duty. Now, the only downside to think about is when you're removing the value of the chattels from the contract, is that a mortgage won't cover the cost of chattels. So you'll need the cash for that portion of the transaction, but then you're saving on the stamp duty. If you've got any questions about this or any of these other ways to save on stamp duty, please comment below, because there's so many different instances where they can create confusion on this. And always check, obviously, with the tax advisor when using these strategies. Thanks for watching, and I'll see you in the next video up here.